The merchant stares at his problem. A fortune in coins, so heavy his horse can't carry them. It's Song China, early 1000s. Trade is booming, but money is breaking backs. Buying a house means hauling wagons of copper. So, merchants improvise. They leave their coins with trusted shopkeepers and walk away with a simple receipt. Soon, these receipts start circulating. Merchants pass them to other merchants, stall to stall, town to town. At first, they're only promises, placeholders waiting to be cashed for real coins. But then, people stop cashing them at all. Why bother with heavy coins when the paper itself was accepted everywhere? The emperor caught on. He realizes he doesn't need to spend on mining and minting all that metal anymore. He can simply print paper. And so, the world's first banknotes are born. Everyone must accept that this paper is now money. From that day on, money was no longer a limited supply of precious metals, but endless prints of worthless paper.
Have you ever really stopped to think about what money is? I mean, we use it every single day, but its story? Well, it's one of the most dramatic and revolutionary stories in all of human history. So let's dive right in. We're going to take this incredible journey through how we've exchanged value, starting with ancient bartering and going all the way to today's lightning-fast global markets. So, this is the big question we're going to try and answer. How did we make that jump? It seems absolutely massive, right? Going from something you can physically touch, like a cow, to just a digital blip on a computer screen. But as you'll see, every single step in that evolution was a clever solution to a very real problem. Okay, let's wind the clock all the way back to the beginning. Before there were coins, before paper bills, before anything you or I would recognize as money, we just had the simple act of trade. And this, right away, created a fundamental challenge. And here's that problem, right here. It's a fancy term called the double coincidence of wants. It sounds kind of complicated, but it's actually super simple. For a trade to work, I have to have what you want, and you have to have what I want at the exact same moment. Just imagine you're a web designer and you need a loaf of bread. You'd have to find a baker who just so happens to need a new website right when you're hungry. Good luck with that. It's just incredibly inefficient. So all that inefficiency created the need for a huge innovation, commodity money. Instead of trading my stuff directly for your stuff, we all agree on a common item that has its own value. Things like salt or shells, and of course, eventually precious metals like gold and silver. And just like that, the double coincidence problem vanished. You could sell whatever you had for gold and then take that gold and buy whatever you needed from anyone. It was a game changer. Now, this idea of using a valuable commodity, especially gold, wasn't just a flash in the pan. It would actually evolve into a much more formal, much more powerful system that would go on to dominate the world for about a century. We're talking about the gold standard. So, welcome to the gold standard era. Here's the most important part. Money was no longer just like gold, it was physically backed by it. A government couldn't just fire up the printing presses and make more cash whenever it wanted. Nope. Every single dollar or pound in circulation represented a real physical amount of gold sitting in a vault somewhere. And that created this incredible sense of trust and stability, which is basically rocket fuel for global trade. But here's the twist. The system's greatest strength, that it was so rigid and stable, ended up being its fatal flaw. When massive global crises hit, like World War I and then the Great Depression, governments desperately needed to be flexible. They needed to spend a ton of money to fund armies or to stimulate their failing economies. But they couldn't just print it because of that promise, that peg to gold. So under all that pressure, the standard just broke. So after all the chaos of 2 world wars and a global depression, the world leaders knew they had to come up with something new. So in 1944, they all gathered at this famous conference in Bretton Woods, New Hampshire, to basically design a whole new architecture for the post-war economy. And at the very heart of that new system was one single, incredibly powerful currency. $35. Remember this number. This single figure was the bedrock of the entire global economy for almost 30 years. It was the price, the promise, that the United States government would exchange 1 ounce of gold for 35 of its dollars. Everything, and I mean everything, was built on top of this one promise. The system they built was actually a pretty simple hierarchy. Think of it like a pyramid. At the very bottom, the foundation, you had physical gold. Then, right on top of that, the US dollar was pegged directly to that gold. And then, every other major world currency was pegged to the US dollar. This officially made the dollar the world's undisputed reserve currency. It was the anchor for all of global finance. Well, just like the original gold standard, this new system also had a breaking point. You see, the US started spending a ton of money, especially on the Vietnam War and big social programs at home. It was printing more and more dollars, and other countries started to get, well, a little nervous. They'd look at all these dollars floating around the world, then they'd look at the amount of gold sitting in Fort Knox, and they started to realize, wait a minute, the math here doesn't add up. And then, the bombshell. On August 15th, 1971, President Nixon went on television and, just like that, unilaterally severed the dollar's last link to gold. This moment became known as the Nixon shock, and it instantly blew up the Bretton Woods system. The anchor was gone. So what happens when you cut the cord? What happens when money is no longer tied to anything physical at all? Well, you enter a brand new world. The world of what we call fiat money, which is just currency that has value simply because a government says it does. And that, my friends, is the world we live in right now. This number is just to give you a sense of the sheer mind-boggling scale of our modern system. With currencies no longer fixed to anything, they started to float. Their values began changing constantly against one another. This created the foreign exchange market, you might know it as Forex, which is now the single largest financial market on the planet, with trillions of dollars traded every single day. All right, so if money isn't backed by gold anymore, what on earth gives it value? What is it that determines whether the dollar is strong or the yen is weak on any given day? Well, it's a much more complex and frankly chaotic dance of different forces. Today, a currency's value is really a dynamic mix of all these different things. You've got everything from a country's interest rates and its inflation numbers to the overall stability of its economy, and even just pure market speculation. All of it is constantly pushing and pulling on a currency's value, literally second by second. So, let's just do a quick recap of the whole journey. We started with the rigid gold standard, which broke because it couldn't handle big crises. Then we moved to the dollar-centric Bretton Woods system, which buckled when its anchor, the US, couldn't hold the weight anymore. And that led us to where we are now, our current system of floating rates, where value is just set by the market itself. You see the pattern? Each system solved the problems of the one before it, but created a whole new set of challenges. And that brings us right up to today. This system of floating currencies has been the standard now for over half a century. That's longer than any other modern system has lasted. But with the rise of digital currencies, cryptocurrencies, and all kinds of new economic pressures, it really makes you wonder, what problem will the next evolution of money try to solve? And what on earth will that look like?